Hi, this is James Robinson, and today we're going to continue with our analysis of Weyco. Today we're going to talk about the company's ability to create wealth for its shareholders. So today we're going to, first thing we're going to talk about is share repurchases. One of the things that a company can do with the profits that makes the investors wealthier is to buy back shares. When they buy back shares, it means that the owners that are left own a correspondingly larger portion of the company and thus should get a larger share of the profits. So you can see in 1999, this company had 13 million shares outstanding. Today it has about 10 million shares outstanding. So since 1999, the company's bought about 30% of the stock back. They bought back about 12% of the stock in the last 10 years, which is more the number that I look at. You can see that in most of those years, it's bought back significant portions of shares, although nothing crazy. Looked at through another filter, if you had owned 10% of Weyco's shares at the end of 2008, you'd own about 1.14 million shares, 1,140,000 shares. Today, through stock repurchases, that same number of shares would mean that your ownership in the country has increased from 10% to 11.2%. So you'd own about 12% more of the company over the last 12 years. That's without investing another penny. It is interesting to note, however, that your shares in the company's earnings would have gone from 1,280,000 to 2.3 million over those 10 years. So your share of the company's income didn't double. Effectively, what's happened is that you've bought back shares, but the company's earnings have been relatively flat, especially over the last 5 years. Again, I'm not buying this stock strictly because of its ability to create wealth. I'm buying this stock because I think for the quality of company it is, it's a little bit undervalued, and I do not think I'm going to own this company 10 years from now. I think I'm going to hopefully own this company, less than 2 years from now. It'll have adjusted price and I'll have moved on. So here you see shareholders' equity. You can see it's gone from about 75 million in 1999 to about 210 million today. That means it's tripled. That's made even more respectable when you figure that over that time they bought back 30% of the company. And then when they buy back shares, they're reducing their amount of cash, which reduces their amount of equity because they're giving it out to shareholders. And this is shareholders' equity in total millions, not per share. If you looked at shareholders' equity per share, it would be much steeper. But effectively, and also the company's paid a solid dividend for most of that time. So this is a good, well-managed, conservative company, which is doing things that are going to increase value for its shareholders. You know that one of the things that I love is return on assets. A company has to keep a certain amount of money tied up in its operations. And I don't mind that. The question is, what kind of return do they get for the money that they keep tied up? If they keep a whole bunch of money tied up and the profits never go up and they break even, well, then that's a waste of that money. If they keep a little bit of money and they make the profits go up and they do fantastic, then it's a really efficient use of money. So that's called return on assets. So the thing to keep in mind here is that this is a measure of how well they're doing return on assets. The lines, the top 10% is the top 10% of other companies that I've looked at. So most companies are not able to get a return on assets above, call it 5 or 6%. This company is in the top 25% of companies in terms of efficient use of its assets. That's pretty solid. It's been very, very stable at that line since 2009. So again, I continue to believe there's nothing wrong with this company, no reason to justify why it had the big stock price drop that it did, which is, again, one of the reasons why I bought it on the dip. So return on equity is someplace that my companies tend to fall short on. So return on assets is how much money has the company got tied up and what kind of return is it getting. Return on equity is looking at the exact same thing, but instead of looking at assets, we're looking at equity. So it's assets minus debt. And it's in effect rewarding companies that have debt that are able to use it efficiently. This company has no debt, and so it's not getting rewarded for that. And it's compared, when you look at these lines, the red and the green and the blue, when you compare those lines, that's how it's doing against the average company in my 1,000 companies that I've analyzed. And so we're not going to perform as well here as other solid companies who have a bunch of debt. We just can't, because we don't have the benefit of that equity to lever up our returns. But so I only really look at the return on equity when I have companies who carry some debt as well as having good returns on assets. But it's one of the things I look at, so I'm describing it here. So retained earnings, just by way of explanation, when a company makes profit, one of the things that they can do with that money, and often have to do with that money, is keep some of that money for their ongoing operations. And that's called retained earnings. We don't like a lot of retained earnings because retained earnings means that there's not cash available for dividends and buying back shares. So I tend to like companies that have as little retained earnings as possible. And the interesting thing about this company is that, you know, for 2 of the last 4 years, the company had negative retained earnings. That means that they retained nothing. They gave away more to the shareholders than they actually kept. And they did that while having no debt. So this is fantastic. A company that's able to have profits, and again, the profits have been pretty flat, but they've done that without retaining any money. I don't think you can do that long term. Sooner or later, you have to replace factory equipment and you have to update your facilities and that sort of thing. But in the short term, they've been able to do a great job with that. And so that's one of the things that we really look at. Oftentimes, I'll show you a slide that shows you return on retained earnings. Those slides start to get a little cattywampus when you have a negative retained earnings, so I'm not going to talk about that. But the company obviously has made profits, and if they've retained no money, then obviously they've done great in terms of return on retained earnings. So on to the next slide. So the next slide, total wealth created, is a slide I've really been playing around with and analyzing a lot, sort of independent of individual companies. What I'm really looking at here is there are a number of ways that a company can create wealth for its shareholders, right? So a company creates wealth for us by paying us a dividend. That's black and white. We get a check every quarter. A company can create wealth for us by buying back shares. In theory, that means even though we didn't spend any money, we own a larger percentage of the same company. And while that company with a little bit less cash on hand, in theory, the cash isn't that big a deal because the operations more than cover their needs for cash. A third thing that the company can do is pay back debt, right? When they pay back debt, that benefits us in 2 ways. First of all, it means that we have more equity in the company. Second of all, it means that the cash flow for the company should increase because we're not having to pay the bank. Third of all, it means that we have less risk for bankruptcy. And fourth, it means when the bad times come, we have more borrowing capability should we need it. So we really like when a company pays down debt. Fourth thing the company can do that increases value to us is they can hoard cash. I don't like a company that hoards a lot of cash, but if they do hoard cash, that does make the balance sheet stronger, it gives the company the wherewithal to do more things it needs to do without taking on debt. Oftentimes that cash can be invested at a profit, and so you get a little bit of a return there. So those are the things that a company can do. So when you look at this slide, this simply charts how the company does in each of those categories. And so, for example, you'll see increase in cash will have decreased in some years, but we bought back stock those years, or we paid down debt those years. And so these things all sort of work in tandem with each other. The 2 lines that are most important are the lighter blue line, which is that year's total wealth created. So that's a combination of how much was added up for all those categories. And then the orange line is the cumulative wealth created in the last 5 years. So recognizing that in any given year something could go right or could go wrong, and maybe that's not a good trend, I've decided to add up what we've done in the last 5 years and look at that. And when you look at that trend for this company, you can see that, you know, over every 5-year span since 2008, which is the end of the recession, this company has found a way to create more wealth for us than they did the year before. And I sincerely believe that if a company is able to do that year in and year out, that it's creating wealth for its shareholders. I don't see how a company can have a chart like this and not become much more valuable over time. But we're going to see. I'm doing that analysis on a lot of different companies and looking at this a lot of different ways, and I reserve the right to change my opinion on this. This is sort of a thought exercise for me. So these are the stocks that we bought since starting this YouTube channel, and that we have since sold. And fortunately, we sold all of them at a profit. But it's just good to keep a sense of how we've done with these stocks. I think there's 12 of them. We bought Apple twice. I frankly wish we had kept it. We sold it at $220. We sold it again. We bought it at $191. We sold it at $220. That's a great return, 15%. Then we bought it short time later at $195. Sold it very quickly thereafter, less than a month later, made another 10%. And unfortunately now it's at $260. We sold it at $213. So, you know, we're not geniuses. Sometimes we get things wrong. But, you know, we did make our profits and we got out and invested the money someplace else. But effectively, every one of these stocks has been profitable, and there's a video on every one of these stocks for why we told you to buy it, when we told you to buy it, and we don't always do a video when we sell stocks. In fact, we typically don't. But if you follow us on YouTube at Robinson Stocks, sorry, not on YouTube, if you follow us on Twitter at Robinson Stocks, then you will get a notification whenever I buy or sell a stock. So these are the positions that we still hold that are open. You can see the date we purchased them, today's date, which is not the date we sold them, but that's today's date. How many days we've owned it, how much we invested, what the purchase price was, how many shares we purchased, what today's price was, and that's actually yesterday's price. If the company's paid dividends, how much we've earned in dividends, what I call the investment value, which is today's stock price, plus the dividends we've been paid, and then the net profit, the return on, since we bought it, its annualized return. And so look, we're doing pretty well with all of the stocks we have open. I think we have 3 stocks with a losing position, and I'm going to talk about that real quickly. I'm very likely to sell AGX and Waddell & Reed in the next few weeks. And the reason behind that is those are stocks where I can take a loss, a short-term capital loss, and offset them against other short-term losses. And so they create a tax benefit if I sell them that is not there if I keep them. I'm not convinced that these companies are not going to bounce back, but I am convinced that I can get an instant profit or an instantly offset my losses by the tax benefit if I sell them. And I think I can go find other things I can buy just as well. Don't be surprised if I sell them in the next month and they pop up back in 60 or 90 days. There's a period of time you have to, once you sell a stock, you have to stop from buying it back before you're able to take the tax loss. And so I'll allow that period to expire and then reanalyze these companies and very likely buy them back. But generally speaking, I think we've suggested you should buy 25 companies now. 3 of them are trading at a loss from when we told you to buy them. The rest are all up. Some are up significantly. Many we've closed out of. So I'm very comfortable and happy with our results so far.